Most SME owners make one big mistake. They rely 100% on their business for their retirement. Your business is not your super fund, and if you're treating it that way, then you're taking much more risk than you realize. What if you can't sell the business when you need to? What if the market turns and valuations drop? In this episode of the Unlock Your Business podcast, we'll explore ways in which to grow personal wealth outside of your business. Hi, you're listening to the Unlock Your Business podcast, where we discuss ways you can unlock your personal and business wealth with financial, investment, and business strategies. I'm Rafi Pelagian. I'm a financial advisor and run financial services businesses that aim to help individuals, families, and small to medium business executives manage, grow, and protect their wealth. Through this podcast, I share my experience and knowledge from a financial advisor and business owner's perspective, in addition to my wins and struggles. So if you want an authentic and honest discussion on personal and business growth, investment, management, and unlocking wealth creation strategies, you've come to the right place. The Unlock Your Business podcast is brought to you by financial advice firm Manly Financial Services. Please see the website links in the show notes. We hope you enjoy the discussion. Welcome to the Unlock Your Business podcast. I'm Rafi Pelagian from Manly Financial Services, and today we're going to be talking about ways in which we can grow wealth outside of our businesses in order to diversify down some risk and take opportunities of growth outside of our business. Now, most SME owners, as we all know, pour everything into their business, their time, their money, their energy. But what happens if things go wrong? Or what happens if they want to retire? They're ready to retire, maybe physically if they're blue collar, they break down or they've just lost interest. The goal of this episode is to explore ways that we can over time build personal wealth outside of our businesses so we don't have the risk of not being able to sell, not being able to sell at the right price, or basically relying on our business for our retirement savings. Now, relying on the business for retirement is really risky. It's risky due to overexposure, where the business owner's single biggest asset, in most cases outside of the family home, tends to be, for an SME owner, their business. There's a lot of risk that can happen. It's no different to basically going onto the ASX and buying a small company with a lot of debt, not much earnings, very little earnings, no dividend, and basically investing all of your retirement savings into that company. There's not really much difference in that approach. But because it's our business, because we're a little bit more in control, because you're pulling those levers, we feel that the risk that we're taking in putting all of our money, all of our effort, all of our energy, and in reinvesting in our business, we think that's lower risk, but really it's exactly the same. The common risks here are market downturns, industry disruption, and we've seen a lot of that over the years. Let's go back just before the GFC, or I believe it was just after the GFC, where government regulation changes, for instance, in the insulation industry, meant that insulation bat companies, 1 minute were making so much money that they weren't really doing things, some of them, the right way. There was some injuries and deaths caused because of those, to overnight, basically not making any money at all. Their businesses were almost worthless at that point. You've also seen a lot of industry cost changes, and I think the most topical one of late, which really led to a lot of the inflation that we saw, were supply side challenges that we had post-COVID. So let's look at the building industry, where a lot of builders had signed fixed contracts pre-COVID, fixed price contracts pre-COVID, and then the cost of materials just shot up because the supply wasn't there. Supply side inflation absolutely killed them, and we've seen a lot of issues in the building sector. Another common risk is around illness, injury, or really burnout of the owner. And I think as an SME owner, you would all understand burnout happens. It happens all the time. If you're the business, then what happens if you're no longer around or working at your capacity? That's a huge risk. And then, of course, the other common risk is the difficulty in selling your business or unlocking value from your business based on market demand, based on timing of a buyer to buy your business. Is it a seller's market or a buyer's market? And a good example of the shift in a market that went from a seller's market to a buyer's market would be in financial planning, again, post the global financial crisis, and potentially also early days post the Royal Commission, where at one point if I own a business and I'm selling it, I can almost offer any price and I'll take it because there's a scarcity of sales. And then at that next level, post those two events, there were so many businesses on the market because a lot of people wanted to get out, and therefore it became a buyer's market from a seller's market. Now, if I want to retire at that point and I haven't accumulated a lot of assets outside of my business, and I decide to sell the business at a point where it becomes the buyer's market, not the seller's market, that can greatly affect my situation. What if a business owner that spends 20 years building a business, which many people have, the business is worth, say, $3 million, but struggles to find a buyer with little or no liquidity at retirement? How does that owner retire? It's basically impossible. They would either need to take a lower price, or they would need to stay beyond that desired retirement lifestyle. They're probably not going to be working at their level of efficiency and energy and motivation. That's completely understandable. And therefore, the business value will fall. So these are the risks of putting all our eggs in one basket, that basket being the one that we're most comfortable with, being our business. So let's look at the steps that we can take to reduce the risk as SME owners. Let's look at several steps. The first one is pay yourself first. Okay, really important one. Too many owners reinvest their income, or what should be their income, back into their business. Their funding source for new projects, for staff, when working capital is scarce, is their own money. Okay, and that's not a good way to go. It's important to treat yourself just like any other employee. You've got to pay yourself a fair salary, a comfortable salary so you can meet your ongoing expenses, because the last thing you need is financial stress when you're dealing with your family, your clients, customers, staff, and your business. Use part of your personal income to consistently build wealth outside of your business, whether it be super, whether it be investments in another entity or in personal name, or be property assets. Again, that old analogy, don't keep all your eggs in one basket. It's really important to diversify. Now, the second step is around superannuation, and we want to look at superannuation as a growth engine and as a tax efficiency engine. Okay, superannuation, a lot of people believe, or many people that I've met believe, that superannuation is an investment in itself. It's not. It's a tax environment. It's like having a company or a trust or owning an asset personally. Superannuation, just like them, is a tax bubble, is a tax environment. And many business owners neglect superannuation because at the end of the day, when they maybe start out, they might start out as self-employed, or they might not pay themselves a wage and therefore don't have to pay themselves the super guarantee contribution. It might be a director's fee or a loan or a dividend or something like that they get paid. So you tend to find that most business owners have lower levels of superannuation to a comparable person who took out the same level of revenue and income that was a PAYG, that worked for someone for the same period of time. It happens all the time. But many, they neglect superannuation again because they think it's an investment in itself, and they don't understand that their business is not their retirement, or it shouldn't be their retirement. Again, way too much risk. It's like putting all your retirement funds in an asset that's very risky, maybe a cryptocurrency that you've never heard of, or a small company or something like that. Sure, you're holding the reins and you've got control over your business, but at the end of the day, there's a whole lot of financial risk that you're taking if your business is your retirement. What are the benefits of super? For a small business owner, really for anyone, firstly, our earnings within the fund, the investment income within the fund, is taxed at 15% versus our marginal tax rate if the asset was in our name, or if the asset stays in the company, it's being taxed at, say, 27.5%. So there's a huge difference there in terms of tax benefits on investment earnings and capital gains. Again, a capital gains is an interesting one because within a company, the company in itself, if it owns an asset, doesn't have a 50% reduction in capital gains. They will pay capital gains on the total gain that's made out of that asset if it's held within the company. Within a super fund, however, the effective tax rate for an asset held over 12 months and then subsequently sold is only 10%. And when we're in pension phase, it's actually 0%. So there's huge benefits that can be taken, that can be gained by really building your superannuation alongside your business, diversifying your assets within super. The other issue is around one of the secrets to investing that we talk to younger clients about, and that is compound interest. When I'm investing in assets within the super environment, I'm earning interest. Earning interest and income that I'm reinvesting back into the business. Now, the next month, I earn more interest. And I'm then earning not only interest on that original capital, but I'm earning interest on interest. And interest on interest is called compound interest. That's the secret to investing. It's about time and it's about compound interest. Clearly, you've got to be in the right assets, this, that, and the other. But the key for investing is really about time, so that you can benefit from the interest. If you can benefit from the interest on interest or the compound interest. And that's going to give you a lot of gains going forward, a lot more gains than maybe investing funds within your SME. Now, we've also got the ability to use pre-tax and after-tax contributions to build our balances quite quickly. Pre-tax contributions are called concessional, and post-tax contributions are called non-concessional. Now, what we tend to find is a lot of business owners only have a smaller amount in super until they're at a point where they're going to sell their business and take advantage of some tax concessions, some tax benefits by investing funds in superannuation. If a self-employed business owner has less than $500,000 in superannuation, we're able to go back 5 years and basically look at how much contribution they could have made as a pre-tax contribution, which at the moment is $30,000 this year. We can look back at how much they have made versus how much the limit was. And whatever the difference is over that 5-year period, we can make that contribution all in 1 year. Now, the benefit of this is that allows us, one, to put money into super and diversify and invest in other assets. But most importantly, by going back 5 years, paying yourself a little bit more that year. Let's say I went back 5 years and I had a limit of $50,000 extra that I could put in. I could pay myself an extra $50,000 out of the company. Then I can make the super contribution that financial year, which will knock out any tax on that $50,000, right? In any personal income tax on that $50,000. Effectively, that carry forward concessional contribution would give me a huge tax benefit, which would be great. And I would be able to invest those funds in superannuation and grow my retirement nest egg. So that's a huge strategy that can be used by a lot of SME owners. Why? Because typically SME owners pay themselves superannuation last. Why? Because of the way they structure their incomes. A lot of them don't pay themselves as a salary, as an employee, and therefore they don't have to pay themselves the super guarantee contributions, the employer contributions. So some really good strategies to utilize superannuation as a growth engine and as a tax-effective engine, as well as diversifying risk away from our business, because we've put some money aside for our retirement in that beneficial tax environment. Step 3, again, talks to this diversification, diversifying into other asset classes. So when I own all of my business, I'm basically owning a share in a company, right? Owning a company, you own equity. And the equity in my business is the same class of asset as, say, Commonwealth Bank. Obviously, my business is a lot smaller than Commonwealth Bank. It's less secure than Commonwealth Bank. It's got less customers than Commonwealth Bank, and therefore, and most probably has less equity than Commonwealth Bank. As a percentage, of course, as dollar terms, definitely does, but as a percentage of debt to equity. So my ownership of my company, even though it is classed as an Australian share, Australian equity, it's on the other spectrum. It's a small company, and small companies display a lot more risk. Now, the returns can be a lot higher than holding a blue chip stock like a Commonwealth Bank or another sort of stock, but at the end of the day, a potential positive return can be equaled by a potential negative return because the risk for that type of asset is quite high. Therefore, it's really important to look at ways that we can diversify our equity risk in our businesses into other assets that have lower risk. So let's talk about property. We can invest in residential property, obviously in our personal name or a trust or something like that, or commercial. And there's a really good strategy that we can look at if our business needs business premises, using superannuation and buying commercial property. And you would have seen this with a lot of doctors and dentists back in the day, but it's becoming more and more typical, where a business owner has a self-managed super fund, has enough money to start one, that's another topic altogether, goes out there and buys a property, and they might borrow a small amount to buy that property within their superannuation fund. Then their company basically leases that property. Because it's commercial property, the company can lease it. It's got to pay market rent. That's very important. But that's a great way to take the business revenues and be able to help fund your retirement. At the same time, you're the landlord. The tenant, the landlord are one in the same. Obviously, they're wearing different hats, super fund trustee versus business owner. But at the end of the day, as long as we follow the rules around superannuation legislation, the SIS Act, in paying market rent, paying rent on time, this, that, and the other, there's a great way to basically give your business some security in terms of where it's sitting, its tenancy, this, that, and the other. And at the same time, be able to invest more and more in your personal retirement by buying a commercial property within your superannuation fund, and you and your business paying the rent that will help fund the loan or whatever it is on that property. We can also invest in managed funds, exchange traded funds, which are basically baskets of a share index or a market index, or direct shares like Commonwealth Bank, the other banks, mining companies, whatever it may be. Now, the great thing about investing in these types of assets is that we have liquidity. Okay, when we buy property, we don't have liquidity. You can't sell off the toilet to get some cash or part of the house. Obviously, with shares, you can. I buy X amount of ABC proprietary limited shares on the ASX, and if I need some funds for my business or for any other reason, I can sell part of those. I've got that liquidity. Growth income isn't tied to the business. You've diversified a lot of that risk, but at the same time, you've got some liquidity. And liquidity in any investment strategy, whether you're a business owner, a retiree, someone growing their wealth and about to retire, younger, whatever it is, liquidity is key. We've got to have some liquidity in our portfolio. We can look at other types of structures like insurance bonds and other structures that will give us a little bit more tax efficiency. That is something to look at. We've got some protection there from creditors and all other things. However, the tax benefits really aren't there in some of those instances. But the message here is to create a portfolio that balances the risk you're taking in your business. Diversify down some of that risk, because I've got money invested with other assets, property, shares, whatever it is. I'm diversifying away some of the risk. I'm using my business as a growth vehicle for my personal wealth. And isn't that why we're in business in the first place? It sure is, or it should be for most of us. Number 4 is something that is step 4 is an area that's hugely neglected, and that is protect what you've built. Now, what do I mean by neglected? Everyone's got insurance related to their property, their business premises. If they're a landlord, we've got all those covers, right? They might have professional indemnity insurance, other types of indemnity, someone workers' comp, blah, blah, blah. They've got all those insurances. But we don't have the main insurances. The main insurances that are going to protect our business is protecting against the risk of a key person or a guarantor of our business having a disability, an illness, or going through a death event. And we want to protect our business and the main asset that we have from the financial consequences of loss of that key person or loss of that guarantor of business debt. Because at the end of the day, if we had a guarantor of a business suffer some sort of a disability, they're unable to work or something worse, then we effectively would be getting a call from the bank saying, hey, the guarantor's gone, we've got some problems. We have to protect against loss of that guarantor. We have to protect against loss of that key person. So what does a key person do? Or how do we define a key person? Because that's typically the type of cover that we tend to look at. Well, a key person can be responsible for sales, can be responsible for IP within the business, contacts within the industry, whatever you can think of that is of value and difficult to replace. Now, can you replace a salesperson? Of course you can. But how long will it take them to be able to be trained up, to be able to get those skills, to be able to go there and make those sales? So we look at key person protection to cover that period for the business, to be able to find the new person, to be able to train them, to be able to go through the financial speed humps, if you will, until that person's on track and ready to go. So that's a critical area that most people don't look at. Now, what are we protecting against when we look at key person or guarantor cover? We're protecting against the financial consequences of illness, accident, disability, or death. So we're using life insurance style products, but we're doing them in such a way that the ownership is with the company, okay? And we've got a good opportunity there to protect our business. If something were to happen, might be temporary, might be permanent, get some funds in, whether it's lump sum or an income stream, depending on what type of life insurance product that we're utilizing, to be able to protect the business, our main asset, from those financial consequences. Now, let's also look at covers, and we're going to do another podcast that goes more in terms of this, but buy-sell agreements. Again, buy-sell agreements aren't something that a lot of people know of, but the key with buy-sell agreements is, what are we doing here? We're protecting the business that has multiple partners from the passing, the death, the disability, whatever it is, of one of those partners. Okay? So if there was an illness, an accident, a disability, or a death event of one of those partners within the business, the other partners are going to have to do one of two things. Either they're going to buy out the partner's dependents, here's the money, we buy your shares off you, or if they don't have the money, what are they going to have to do? They're going to have to run the business with those dependents. Will those dependents have the necessary skills, acumen, IP, whatever it is, to knowledge to be able to run that business? No, probably not. So what will effectively happen is that in most cases, there'll be a drag on the business. So a buy-sell agreement and the buy-sell insurance allows the business to get a lump sum of funds that they can basically pay to the dependents of that business partner, buy them out, and it's a lot easier, a lot cheaper than borrowing out of our home loans, selling down our personal assets, or borrowing from a commercial loan. Okay, and we'll go into that in a further podcast because I think it's really an important area, this business risk management area. The buy-sell agreement effectively is the agreement that governs it. It's like a business will, basically saying if something happens to one of these four partners, let's say there's four of them, then this is the way we're going to deal with it. Okay, we're going to pay them out, we're going to buy them out, this, that, and the other. If everyone's signed off on it, then at the end of the day, that's just going to be executed once the funds come in from the insurance. And that's where we help in terms of managing the risk to be able to provide the funds. Make sure, the other key point here, around protection is the estate planning. Making sure everything is structured in such a way that it's correct, it's effective, it's tax effective, it's cost effective for any family wealth transfer. And that's critical and something that should be looked into. Step 5 is plan your exit early. Plan your exit early. So if you're at a point where you're thinking, okay, I'm losing my motivation to do this and this, that, and the other, don't wait till you're 60 plus. Think about selling or at least succession. Is there someone in your business you can groom as a potential successor? Could you get closer to the competitor in your particular area that may want to buy your business when you're ready to retire? I mean, that might be a great way for them to get market share. The other thing that we've got to do is we've got to look at ways in which we can protect our family from the value of from that value that they could lose if something happened to yourself in the business. So this is, again, similar to your key person cover, but a great way to protect the value your family is going to get is to look at a life insurance or a TPD policy that will give you the value that you think your business is worth. Now, in this case, you typically find this more for self-employed businesses, smaller businesses. It might be particular tradie, one-man band or whatever it is, and they know that their business could be sold for, I don't know, say $3 million. I want to lock that price in. The way I can lock that price in for my family to protect them is to get a policy, life, TPD, trauma, whatever it is, for a $3 million amount. If something were to happen to me, I know that my family is going to get that $3 million. They're protected. If we can sell the business in the interim, then we just cancel the insurance policy and we're all happy. It's just giving you that safety net just in case something were to happen as you're approaching that sale. Your exit planning within your business should run parallel to wealth creation. Now, what does that mean? That means that when we're looking at selling our businesses, we've got that successor there, we've got that competitor, whatever it is, who's going to buy the business or someone who's going to enter. We've got to start looking at that not just from the lens of let's reduce tax. Of course, that's critical, but we've got to get our lawyer involved to make sure everything's protected and structured the right way, our accountant who's going to help with our tax planning, and then our financial planner that's going to help put together the investment mix using superannuation and other assets so that we've got the most tax effective, cost effective and flexible retirement vehicle going forward. as we retire. So there are our 5 steps in terms of looking at ways that we can effectively diversify risk outside of our business for ourselves personally and build wealth outside of our business, as well as the hard work that we're putting in our SME businesses. So again, as a recap, the steps were: pay yourself first, use superannuation effectively. Remember, it's a tax environment. There's a lot of benefits that can be utilized there, and we want to utilize super as much as we can in retirement. Diversify investments. Are there ways in which we can look at other investments that are owned in other vehicles that even the business can benefit from? Like I said, in terms of a commercial property or something else. Protect your assets, critical. Don't just get those general insurances. They're very important, but extremely important to look at protecting the risk of loss of a key person, a business guarantor, or one of the partners. And plan your exit. Very critical. If you're looking at selling your business, if it's a business that you believe has capital value and should be sold at some point, and you're going to recoup that value to help fund your retirement or whatever it may be, you've got to plan your exit. You can't just expect that the world's going to be ready when you're ready. You've got to start planning it early. So the key takeaway here is that your business should support your wealth, should grow your wealth, and not be your wealth. And these 5 particular steps will really help you get on the right track to have your business support your wealth and help grow your wealth. If you're an SME owner and you would like to explore some of these personal wealth strategies outside of your business, please reach out for a chat. You can visit our website at www.manlyfs.com.au for more information. We've got heaps of free information on the website and different resources. So please reach out, look at some of that information, and you can find ways on our website to get in contact. Thanks for listening to the Unlock Your Business podcast. We use this vehicle of the podcast to be able to give information out to people from our knowledge, from our experience, from our day-to-day learnings, to business people, to family groups, to individuals. We hope that you got some value in listening to this episode that is discussing issues that we commonly as SME owners miss. Why? Because we're so busy putting out fires in different areas or looking at new opportunities. But it's really important to take stock, slow down sometimes, and have a look at some of these areas. Please subscribe to our podcast wherever you consume your podcast content, and also to our Manly Financial Services YouTube channel. And we'll see you in the next one.